About hedge fund investment strategies, and various strategies would be discussed, but we'll focus on four broad strategies: arbitrage, event driven, equity related, and macro. In arbitrage and event driven strategy, investors try to find discrepancies in and profit from them. Opportunities are found through extensive research and computer models. In case of equity related and macro strategies, profit is driven by market movement, and investors try to anticipate price movements based on research and models. So let's look at the first one, equity based strategy. Now equity based strategies are associated with execution mechanism, return sources, and cost. So the first type here is equity long short strategy. The equity long short strategy applies fundamental analysis of a company or companies, focusing on a particular risk or an opportunity specific to a firm's industry, location, and the overall macroeconomic environment. The strategy's overall goal is to take a long short position and exploit mispricing, at the same time decrease market risk. This type of skilled stock selection will help generate alpha. So sources of return include alpha returns from long short position, interest, rebate. Interest, investors can earn interest on the short sale less the lending fees expenses. This is rebate is generally 70 to 90% of the total interest. Interest from liquidity buffer. When the strategy is initiated, a liquidity buffer is posted in order to cover the mark to market adjustment, which is done on daily basis. It also covers dividends to lend the stock. The liquidity buffer earns short term interest. The cost include cost associated with borrowing, shares, cost of margin loans on short position, and transaction cost. Now we have non-hedged equity strategy. The non-hedged equity strategy also relies on fundamental analysis, but it is long only. The focus is on individual firms or industries. This is more traditional stock picking strategy. The strategy generally has a region or a global focus and incorporate diversification along with market cap lines. Then we have the macro strategy. The macro strategy are used to generate returns by hedge fund, and the macro strategy makes large leverage bet on anticipated price movement in broad equity or fixed income market, interest rate, foreign exchange, and commodities. The global macro strategy takes a derivative position focused on stock, bonds, commodities, loan, real estate, inflation indices. Global macro hedge fund managers try to anticipate changes in international macroeconomic trends and take large position in order to earn profit. They can allocate capital across sector, regions, or asset classes. Many factors may be considered, including economic forecast, international fund flow, trend in interest rate environment, political upheaval, relationship between countries, economic policies, and other broad issues that affect market. Emerging market strategy. The emerging market strategy, either in security or in either in securities of emerging countries or those of sovereign countries with sovereign debt. Emerging market is when there is strong growth along with industrialization. The goal is higher return, however, these returns are accompanied by higher risk. Then we have arbitrage strategy. And with this we have fixed income arbitrage, convertible arbitrage, and relative value arbitrage. Arbitrage strategies seek out situations where the same asset trades at different prices in different markets. Two assets with similar cash flow at different prices, or one asset with established future prices trades at a different price today discounted by the risk-free rate. Fixed income arbitrage strategy. The fixed income arbitrage strategy is long short strategy that looks for pricing inefficiencies between various fixed income securities. An example is shorting US Treasury bonds and going long on another country's bond future. The arbitrage count on eventually price convergence of the two. Then we have convertible arbitrage strategy. A convertible bond essentially contains an embedded equity call option. The bondholder has the right to convert the bond into predefined number of common shares and would logically exercise this option if the value of the common equity is greater than the cash redemption value of the bond. But up till that time, the investor receives coupon payment just like a traditional bondholder. The convertible bond price is sensitive to interest rate changes, issuer credit risk, issuer common share price, and the degree of volatility of that price. Thus, there are three sources in reviewing convertible bond prices: investment value, conversion value, and option value. The Black-Scholes motor option pricing model can be used to price the convertible in conjunction with bond valuation model. However, binomial option is better model for valuing convertible security. In a convertible arbitrage strategy, the investor want to exploit pricing inefficiencies in the convertible pricing in relation to embedded call option of the issuer underlying common stock. A hedge is implemented and managed through a dynamic hedging strategy. A convertible bond arbitrage is the creation of a hedge where the investor purchases a convertible bond and sells short the underlying stock. The investor or arbitrager profits from income as well as from equity volatility. The hedge fund neutralizes equity risk, but the risk must be continually managed by manager managing the short position in the issuer stock or through delta hedging. The hedge will produce profit if done properly, and there is an additional income from a periodic bond coupon payment as well as the interest income associated with the short sale of the stock. An expense to the, to the investor is the cash payment to the lender of the stock equals to the dividend that the stock lender would have received if not loaned against the arbitrager. The objective of strategy is a double-digit annual return, and this may be achieved if volatility exposure generate positive returns over the implied and above the implied volatility of the convertible bond when the hedge is initially established. Relative value arbitrage strategy. The relative value arbitrage strategy looks for pricing inefficiencies across asset classes and attempts to exploit these efficiencies. Pair trading is typically relative value arbitrage strategy. The investor look for two firms that may be competitors or peers, and these securities may have strong historical price correlation that has temporarily broken down. A pair trading will short one stock and buy the other with the hope that separate between the separation or the spread between the two securities will return to previous point and converge. Another example of relative value arbitrage involves trading between exchanges. An investor will look for correlation between a stock traded in one exchange compared to a future on that stock on another exchange. Example would be New York Stock Exchange and Chicago Mercantile Exchange. Computer programs look for divergence with the expectation that prices will eventually converge. This strategy typically involves very small price discrepancies and accompanying large volume. Describe the mechanics of an arbitrage strategy using an example. To demonstrate an arbitrage strategy, consider two scenarios, both involving the purchase of a convertible bond. In one example, the investor goes long on a convertible bond but does not hedge the position. In another example, the investor goes long on a convertible bond but instead set up an arbitrage trade by shorting a quantity of underlying equity. So that was about the arbitrage strategy. We now move to event-driven strategies, and at the end we are going to look at a numerical of this arbitrage strategy in example using convertible arbitrage trade and hedged convertible arbitrage trade. We are now going to look at event-driven strategies including activism, merger arbitrage, and distressed securities. Event-driven strategies are focused on specific corporate events that create pricing discrepancies and inefficiencies. Various event-driven strategies and event-driven investment opportunities include risk arbitrage, looking at firm strategic alternative and taking a position, analyzing potential spin-off of a division or business segment, taking position on potential takeover, anticipating price movement based on credit rating, financing recapitalization, primary offering of debt or equity, bankruptcy reorganization, changing in accountancy method, synergy from merger, corporate turnaround opportunities, senior management change, taking position on litigation outcome. Then we have the activism strategy. Activistic strategy involves taking a position in the company either through equity or derivative position and then trying to influence management or the board to consider various initiatives that the activists believe will boost the share price. Activist investors may push for corporate government changes, corporate spin-off, reduce costs, reduce share balance, more share repurchase, higher dividend, more debt, or number of others. Then we have merger arbitrage strategy. The goal of merger arbitrage strategy is to profit on the spread between acquirer's purchase price offer and the target stock price after announcement of an acquisition, purchase, or merger. In case when the acquiring firm has promised to make eventual payment on in its own stock, the arbitrage may short the arbitrage stock and simultaneously purchase the stock of the target firm. The position will be unwound, presumably at a profit and at the time of merger. In a merger arbitrage strategy, if the deal closes, the arbitrage gains from spread on arbitrage, which is different between target stock when the acquisition is first announced and actual bid price when the deal closes, dividend paid on target stock, interest on proceeds from short position, less borrowing cost and dividend paid out on the short acquired stock position, potential for bidding up of the initial offer, especially in case when there are accompanying bids. There, there is a downside to this strategy. If the deal does not close, then the target stock price will drop to pre-announcement price or perhaps even lower. The acquired stock price may increase, which cause a loss in short position. It is important to understand that with a merger or risk arbitrage, the loss when a deal does not close far outweigh any gain if the deal is successfully completed. Now we discussed. Now we'll discuss the distressed security strategy. Distressed security strategy involves speculation in buying or selling distressed activities. These distressed firms are preparing to enter or exit a bankruptcy. There are shareholders, particularly institutional shareholders, which choose to sell out stock in troubled company rather than ride it out. Also, it is sometimes difficult for market to properly value this situation. For these situation where reluctance of some investor to hold the security and difficulty with market condition, there are opportunities for investor to pick up some of these stocks at large discount to their risk adjusted values. Various ways to profit from distressed securities include: investor can buy and hold securities of a firm entering restructuring in anticipation that the value will increase when the firm exits restructuring. Investor may examine pricing of senior or junior position in the firm's capital structure. Investor can look for mispricing between different securities of the same position. For example, in restructuring situations, senior securities may rise in relative to junior securities. To recapitalize on this pricing, or rather this mispricing, an investor can purchase the senior position and short the junior position. Investor may purchase securities held by a creditor in a bankruptcy. So this strategy can be either active or passive. Active strategies include attempt to influence restructuring process by participating in trade committee, supervise workout process to ensure investors' interest is protected, involvement in large legal process to benefit investors' position. Passive strategies do not get involved and prefer to seek out less complicated or time-intensive distressed investment. Now we'll look the mechanics involved in event-driven arbitrage, including their upside and downside risk. Activistic strategy. The activistic strategy involves taking a position in the hope that the company's senior management or board will consider and implement various initiatives to boost stock price. The upside, if the investor is successful, is restructuring will take place and share price will likely increase. Company will buy out activities share at a premium to satisfy demand. The downside, if the investor is unsuccessful, company will make no changes. The stock prices may remain same or decline. The merger arbitrage. The merger arbitrage involves attempt to achieve gain based on relationship between acquirer's initial price offer and target firm stock price after an announcement of an acquisition or merger is made. The upside is that if a deal closes, investor makes profit as the target firm price converges closer to the date of dealing. More bidders may emerge and offer price to be improved. Additional returns are realized through receipt of any dividend in the interim. The downside, if the risk does not close, is that the price of the potential acquisition stays the same. Now we move to distressed security strategies. As mentioned previously, distressed security strategies focus on firm on distress and typically involve a bankruptcy or restructuring. Example of various return from distressed secure strategies include: investors may buy share in a company until it re-emerges from bankruptcy. Investor may purchase non-investment grade bond which may price attractively because of institutional investors or pension funds are prohibited from purchasing such debt. Bank may wish to sell off some bank debt to clean up their balance sheet and investor may purchase this debt. Trade claims are attractive to some investors since there is a payment risk in the event of a bankruptcy and the trade claims may be purchased at discount. Now we have to look at numerical example of the strategy: merger arbitrage, pair trading, distressed investment, and global macro. So I'll look at a numerical on each one of them.